RIN TV coverage of the 2015 European Insurance Forum is brought to you by the Dublin International Insurance and Management Association. It's been a long time coming, but Solvency II will be implemented on the 1st of January 2016. The EU Directive has gone through many iterations since its inception. We had the opportunity to speak with Karel van Hulle about the long and winding road to Solvency II during the recent European Insurance Forum in Dublin. He is Associate Professor at the Goethe University in Frankfurt. He is Chairman of the Insurance and Reinsurance Stakeholder Group of EIOPA. And while retired from his role as insurance head for the EC, he was responsible for the early development of Solvency II. In fact, he has been referred to as the father of Solvency II. Here are the highlights.
When I was asked to develop Solvency II, when I was in charge of insurance and pensions at the European Commission, the questions that we had to resolve were phenomenal. In fact, the European insurance regulation had not profoundly changed since 30 years. We had a system that was all dated, that did not include any incentive for management to have good risk management. It was a system that did not attach any importance to the qualitative sides of supervision, which mean governance and issues like that. It was a system that didn't know very well group supervision because supervisors were all still believing, mind you, this was before the financial crisis, that supervision could be done on a solo basis, so that you did not have to look at the group situation of an insurance undertaking. And also very importantly, there was not an early warning signal in the system. That means if an insurer got into difficulties, it was usually too late to do anything about that. Now, Solvency II was supposed to change all these things. And that was a formidable exercise, I can assure you. Well, when we developed Solvency II, the objectives were basically to improve risk management. And we tried to do that by putting the responsibility of running the insurance undertaking back to management. It imposes a requirement on management to carry out an own risk and solvency assessment. So they can no longer say, I rely on a standard formula which defines my solvency capital requirement. No, the management has to do an own conscience examination to see whether the standard formula really suits the particular enterprise. Now, we also tried through Solvency II to develop a principle-based approach. Because what we've learned from the past is if you develop rules in great detail, people have a kind of a tick-the-box exercise. So when the process started, there was a lot of enthusiasm in Europe to have this new solvency approach. But then we had the financial crisis. And I can tell you, we did not plan that. It came as a surprise overnight. And it put into question some of the issues that we had designed in the Solvency II framework. One of the issues was that the low interest rate environment created a lot of volatility in the calculation of what we call in Europe technical provisions, which in the US is referred to as reserves, so that we had a lot of volatility in the solvency capital requirement. So we had to do something about that. And we could only do that by going into a lot of detail, which I do regret because, as I said from the beginning, the principle-based approach, I believe, was very important. So we had to change that. We also had to change some of the regulatory approaches that we had adopted by putting more responsibility to EIOPA for the development of implementing and regulatory technical standards, which the European Commission can then endorse, so they become legally binding. So the structure of the development of legislation has also changed. A problem we also faced is that we require all the insurers to draw up a solvency balance sheet, which is based on a market-consistent basis. Now, valuation on a market-consistent basis, all the literature will tell you you have to discount using the risk-free rate. Now, what is risk-free today? The financial crisis told us nothing is risk-free anymore. So we had to design new structures for the valuation of these technical provisions, of these reserves, and that became rather difficult. When you develop a project like Solvency II, which basically means a complete overhaul of the solvency regime, you face a lot of important challenges. Finding an agreement between 5,000 insurance companies, 27 member states, and 700 members of the European Parliament, I can assure you, is not evident. And of course, I felt a number of times rather frustrated. It's so difficult to develop a relationship of trust between the supervisors and the industry. Industry doesn't trust the supervisors, so they want always more detailed rules. And the supervisors, they don't trust the industry, so they also want to go into details. So that is rather frustrating. Also, politics. Politics intervene at the most unexpected moments. And I faced it also during the negotiation of Solvency II after the financial crisis, when I had a Council of Ministers and the European Parliament that were quarreling, and the debate was much more about who has the power to do what than what are the real issues that we need to resolve. And that, I can assure you, is frustrating. Well, the next challenge, now that we have in Europe Solvency II, is what is going to happen at the international level. I've had the privilege to discuss with the NAIC, with the American insurance industry, many times solvency capital standards. And of course, the views are not the same. I think the US has a problem in the sense that a lot of energy is spent on the debate, who is in charge? Is it the state level? Is it the federal level? I can accept that. I can understand that coming from Europe, where we have a similar debate between the state level and the European level. But we've passed that stage now. And I think in the US it is very important that people put their mindset now on the future. Not on the defense of the past. I've nothing against the past, but we cannot possibly argue today that the world hasn't changed. I think the RBC system in the US, which is ahead of what we have now in Europe under Solvency I, should also be changed. It should be modernized. There is this modernization exercise that the NAIC has launched, but it falls a little bit between the chairs in the debate about who is the competence for what. And I know that in the Congress, people are asking questions, where is the authority for the IAS to impose an international capital standard? I'm not sure that that is necessarily the question. The IAS is actually working on what has been asked by the Financial Stability Board. The Federal Reserve is a member of the Financial Stability Board. They know what they've been asking. So the same country cannot ask the question twice. One party saying, we want to do that, the other party saying, you have no right to ask us to do that. In Europe, we have similar debates. I mean, let's not be mistaken. It's not in Europe that everybody says what the IAS is doing is perfect. I think the question also, rightly, is being asked in Europe, where's the authority of an international body now changing Solvency II, which we have just introduced? But here again, my answer to that is, let's keep an open mind. Let's try to do things together, because in a globalizing world, the last thing we can do is to just believe we can continue to work, the Europeans in Europe, the Americans in the US, the Chinese in China. We should work together, try to develop a better system, not by imposing our system on the others, but trying to design something which is compatible both with the US regime, RBC, and with the Solvency II. And I believe that will be possible. There's only one way for me, and that's forward.
For more of our coverage of the 2015 European Insurance Forum, visit the DEMA website or the special 2015 EIF channel in the RIN TV On Demand library.